Hi everyone, Basil Chapman sitting in for Tom O'Brien. I'm the host of the Tiger Technicians Hour, noon to 1 p.m. Sitting in for Tom right now. My pleasure and honor to be here. And I have a daily newsletter called The Opening Call. And just before we kick off anything, I just want to mention tomorrow night at 5 o'clock till 6:30, I'm doing a webinar. It is a webinar, really, where are we? What's next? And that's really the title is, What's Next for the Market? Tuesday, December the 4th. Go to the front page of TFNN. You can check it out. The topics to discuss, sectors that should rally in 2019. We're getting really good clues right now. I'll talk about that in a moment. Which are weak, stocks to consider, and levels to watch in each index. And looking at portfolios over the period of time, what's the risk to the downside now? If everything goes wrong, what could we be looking at? Everything it goes right in sectors or sections, what we'll be looking at. It's really going to be a very important moment to be looking, because we've had the for subscribers, we're actually long going into the weekend. So this big gap up in the Dow today was really important, and it at least gives a cushion. But I was discussing in the last hour that there's a trend line. If you look at the daily chart, you see this thin green line, little dashed green line, and the red line. They make a channel, a little mini channel going down. I call that the repellent zone. We have to see a good crossing over it into the 26,050s, and that way we'll say, now you've got some decent support in the 25,400 to 25,000 level if more bad news comes along. I think just for the moment, we're looking at the market wanting to ameliorate all the tensions. So there's a bias towards buying at this stage. And I got a little nervous over the weekend, or going into the weekend, all of last week and into the weekend, when I heard so many people talk about the year-end rally, and it just went on and on. Yes, we should rally, we should rally. And I'm saying to myself, on a very short-term basis, I've got my 120-minute chart suggesting that we're a little extended. So the pullback that we had today was good. The fact that we ended the Dow going all the way to just about 26,000, 25,980, pulling back to 25,670, and yet closing at 25,826, kind of in the middle of that range, the middle of the trading range, but way above the close of Friday. To me, this is a good sign. There's a point where we would probably fill in the gap from Friday's close to today's open. But I think there's enough to ameliorate some of the downward pressure. Let me show you what I'm looking at. The S&P, well, before I do that, I better show the Dow, these rectangles. I'll talk about them in a little while. I spoke about them earlier. These patterns are matching the pattern in this weekly chart of the Dow from the 26,616 January high to the January and then April lows, and the high from the all-time high, 26,951 in October, that never closed above 26,616. That to me is important. I think we're in another rectangle, and we should chop around, at least for the very short term, with a slight upside bias. Wednesday's closed, so the market is closed, and I suspect that tomorrow we might just see kind of a little hesitancy, because coming back on Thursday, people aren't going to be sure what happens between now and then, but we'll see what happens. So the S&P also needs to break above this downtrend line. Let me show you right here. S&P has the same thing. So there's a downtrend line, which it actually took out today. It's above it at 2790. That's important because this arch formation, called the lowercase h, can turn into a cup formation if there's a decisive close above the left side arch high. That's the high of 2814, 2815, that area. The close in the 2819s, anytime this week that holds for 2 sessions, at least holds higher like that for 2 sessions, would say great, because now you can go further to the upside, and that's what we'd be looking at. Any breakdown below 2755 would be 2765 actually, would be very negative. The QQQ, this is the NDX 100 trading vehicle. This is the Invesco QQQ Trust Series. Traded quite nicely. The weekly doesn't look too good. The monthly doesn't look too good, but the daily has improved a lot. And it's saying at 172 It's the 175. So if it can close above 175, actually the real number is 175.58. A good close above that, up towards the almost 176, would say, hey, this can go even a little higher in December. That's going to be very important. Now, I want you to look at the IWM just briefly because it's been the laggard. It's still the laggard. Look, IWM trading at 154.21, up $1.52. It needs very quickly to get into the 158s. That's 4 points. That's a lot of points. But if it can get there in the next week, that's going to be very positive. Any pullback, any failure says, uh-oh, just stuck in the doldrums. Gold. Gold had a very nice session, closing up 10 at 12.36. The weekly chart is still suggesting it's stuck in a range. Here's going to be the issue. If gold is able to climb above 1256 towards the 1259 200-period exponential moving average in the daily chart, not only is that very good action, but it turns the weekly chart into higher lows and higher lows and higher highs, and it's suggesting very strongly that gold, even though I'm very favorably leaning towards the dollar since April, and I'll show you the dollar chart right here, it means that gold could actually benefit if the dollar at 97.03 by Friday of this week starts to trade under 96.20. I probably would say to you, if it closes in the 95s on any day, that weekly chart is all of a sudden going to show some weakness, W-E-E-K, W-E-A-K. Weekly becomes weak, but weak in the sense that it has been fabulous for months, and that it could take a breather. It could take a timeout. It hasn't had a timeout other than a couple of weeks here and there. We'll see what happens. But I can just tell you this, if the dollar closes in the 97.70s at any point between now and Tuesday week, that's really good action. That just says dollar's just, Tom always calls it king dollar. That would say, yep, king dollar, that's what it is. Okay, so we wanted to look at crude oil, and crude oil right now is trading at 53.10. This is the continuous contract up 217. This is the first decent bounce it's had in a while. It's had a lot of bounces, but to the downside. Watching crude oil, because if it can trade from 53s right now into the 55.80, 56.30 area by Friday, and then hold and treat 53s as support, that'll be the first time crude oil has had at least a decent change in trend, short term nevertheless. I'll be right back. Basil Chapman sitting in for Tom O'Brien. The Dow is up.